So you're an American living abroad. You've probably got the local currency down, you know where to get the best coffee, but there's one piece of home that follows you no matter where you go. It's a souvenir you didn't ask for, the US tax system. Let's break down the unwritten rules every single expat needs to know.
Right, you've packed up, you've moved across the world, you're earning in euros or yen or whatever. It feels like you should be done with the IRS, right? You might think you've finally escaped. But have you? Well, that's the big question, isn't it? And the answer is the foundation for everything we're about to talk about.
And there it is. This is the one rule you have to burn into your brain. Unlike almost every other country on the planet, the United States taxes you based on your citizenship, not where you happen to live. It doesn't matter if you're in Tokyo, London, or Panama. If you've got that US passport, your global income is on the IRS's radar. Period. End of story.
So right off the bat, this whole worldwide taxation thing creates a massive problem. You could get taxed twice. You could end up paying taxes to the country where you actually live and paying taxes to the United States on the very same income. Honestly, the rest of the super complicated US expat tax system, it's really just a set of tools designed to solve that one single problem.
So how do you deal with that double taxation nightmare? Well, you've got two main tools at your disposal, and choosing between them is not just about ticking a different box on a form. No. This is your first big strategic decision, and it has real long-term consequences for your finances. Let's break them down.
First up is the Foreign Earned Income Exclusion, or what everyone calls the FEIE. This one's pretty easy to get your head around. It lets you just exclude a big chunk of your income from your US tax return. For 2025, we're talking up to $130,000. The key thing to remember here is this tool reduces your taxable income. And then you've got your other option, the Foreign Tax Credit, or FTC. Now this works in a completely different way. Instead of shrinking your income, it directly slashes your final tax bill. It's like a coupon. For every dollar of income tax you've already paid to another country, you can potentially wipe out $1 of tax you owe to the US. This reduces your actual tax owed. Okay, now this is where it gets really interesting, because this chart lays out the whole strategic trade-off. See, the FEIE is simple, but it only works on earned income, like your salary. The FTC, though, it's way more flexible. It can cover all kinds of income, like interest or dividends. And check out that carryover rule. With the FTC, you can save up unused credits for 10 years. That's a total game changer if your income goes up and down.
Now hold on, because there's a huge gotcha with the foreign tax credit. It's called the compulsory payment rule, and it trips up a ton of people. Let's say there's a tax treaty between the US and your country that lets you pay a lower tax rate. You have to take it. If you don't and you end up overpaying your foreign taxes, the IRS basically says, tough luck. That extra payment was your choice, not compulsory. And you get 0 US credit for it.
Okay, so you think you've got your income tax strategy figured out. You're feeling good. But for a lot of expats, the bigger headache, and honestly, the bigger financial risk, has nothing to do with how much tax you owe. It's all about the paperwork, the informational reporting. This is where you can get into real trouble. Let's start with the big one, the FBAR. And this is absolutely crucial. This is not an IRS form. You file with a totally different agency called FinCEN, the Financial Crimes Enforcement Network. And that tells you everything you need to know. This form isn't really about taxes, it's about fighting money laundering and terrorism. And that's exactly why the penalties for getting this wrong are so ridiculously high. So, what triggers this FBAR filing? A pretty low number, just $10,000. But here is the critical catch that gets everyone. It's not $10,000 in one account. It's the aggregate value, the combined total of all your foreign accounts. So if you have 3 accounts with $4,000 in each, you may think you're fine, but you're not. The total hit $12,000, so boom, you now have to report all 3 of them. And believe me, the FBAR is just the tip of the iceberg. Depending on what you're doing overseas, you could be looking at a whole alphabet soup of other forms for foreign assets, owning parts of foreign companies, foreign trusts. Look, the takeaway here isn't to memorize these form numbers. It's to simply be aware that this world exists. If you have any kind of complex foreign investments, you need to talk to a professional. All right, we're gonna pivot now. We're stepping away from the tax code entirely to talk about something just as stressful, a real-world problem that's blindsiding Americans abroad. This is a problem you won't find on any IRS form, and it's about simply being able to keep your US bank account open. So why on earth is this happening? It's not about a new law. It all boils down to one word: risk. For the giant compliance departments at US banks, an account with a bunch of international wire transfers just looks complicated. It raises red flags. So, to make their own lives easier, they might just decide to close your account. And the most frustrating part? They usually don't even have to tell you why. So what in the world can you do about it? Okay, here's a simple 3-step playbook. First, use an intermediary service like Wise for your international money transfers. This puts a buffer between your US bank and the foreign account. Second, isolate that activity. Have one US account that you only use for these international things. That way, if it gets flagged, your other accounts are safe. And third, and if you remember nothing else, remember this: diversify. Always have a backup. Never rely on a single US bank account when you live overseas. You know, when it comes down to it, it's pretty simple. You're living a global life, so your financial strategy has to be global too. It's not just about filing the right tax forms, it's about how you structure your banking, understanding all this reporting, and making smart choices from the very beginning. So, I'll just leave you with this question: is your financial strategy truly as global as your life?